if I look at the latest report which has come from the house of Motilal Oswal Securities, they've cut their Nifty EPS target for FY18 and for FY19. Gautam Duggad joins us, Head of Research with Motilal Oswal Institutional Team. Now, Gautam, good morning. Thank you for joining us. I'm scanning through your strategy note, and you've cut your EPS estimates for FY18 and FY19. So, are you making a case that the worst of the earnings season is not behind us?
Hi, good morning, Nikunj. So what we've said for FY18 estimate is that the shocker from SBI which came for this quarter was not anticipated, and that has actually accounted for 1.6% of that 3%. So if I delve a little more into that, a large part of it was obviously explained by divergence and then provisioning on account of that. So that is one big factor. Secondly, Tata Motors and ONGC are also contributing to that 3% cut that we have seen for FY18 Nifty EPS estimate. So out of the 50 companies, if 3 or 4 which actually took the shin of the entire earnings seasons in 3Q FY18, if you remember, till about 80% of the earnings seasons, the numbers were progressing in line with estimate. And last 4 or 5 big heavyweights, whether it is Lupin or ONGC, Tata Motor, SBI, they have disappointed to a large extent, and they're also actually responsible for a big part of the earnings estimate cut that we have seen. So roughly around 40-45 Nifty companies, you're not seeing major change in Nifty EPS estimate, but this 3-4 companies are actually driving that 3% cut. And even for that matter, if you look at the total earnings also, this 2 or 3 companies have actually impacted the big picture view for the quarter. At least we were expecting around 14% growth for Nifty earnings. We got 7% at the profit level. Sales and EBITDA were in line. But if you look at the numbers again, excluding SBI, if you will, then the numbers are basically healthy. You're looking at 17% kind of a Nifty earnings growth for the quarter versus the anticipated 17%. So numbers were healthy in a way. And of course, the estimate cut that you're seeing is driven by this 3-4 big names.
Even what's happened after the PNB scam and the fact that we don't know how much what bank is connected, what will be the write-off, what would be the recognition, how long they'll continue to treat the contingent liability, I mean the loan as contingent liability. These are known answers. So do you think the aggregate earnings picture will remain distorted for this quarter also?
So I think you made a fair point. As far as the visibility of earnings estimates are concerned for those pockets of banks, especially the PSU banks and maybe to some extent the private corporate oriented banks, there the visibility is very uncertain today. So if I look at my Nifty estimates for FY19, while we are projecting a 25-26% earnings growth, around 595 rupees of EPS for FY19 for Nifty, 40% of that incremental growth is being contributed by 4 companies, which is SBI, ICICI, Axis and Tata Motors. So the concentration for the growth in FY19 is very high, and to that extent it lends uncertainty. So while the numbers are looking very strong at 20% plus kind of an estimate growth, but it is coming from sectors which are very vulnerable to quarterly swings, and where the visibility, especially in the last 10-15 days or what happened, not just from the PNB issue, but also what RBI has done for the non-NPA stress asset resolution framework, even that is creating some sort of volatility on the provisioning estimate. I think that the NPA acceleration will happen for the next 2 quarters because of what happened on the non-NPA asset recognition or asset resolution framework that RBI has proposed. So that will result into some acceleration of NPA. So therefore, to that extent, there will be volatility on earnings estimate for FY19 as well. But I must say that FY18 so far, if you compare it with FY15, 16 and 17, the earnings stability, or rather the stability of earnings estimate, is far higher compared to the last 3 years. If you go back in the previous years, till February in 17 or 16 or in 15, we would have downgraded almost the entire growth for that particular year. This year we started with I think 17 or 18% earnings growth for Nifty. We are still talking about 12-13%. So relatively speaking, compared to the last 3 years, the experience that we've had on earnings progression, FY18 is still looking better compared to those 3 years.
Okay, fair point. Gautam, since you're saying that it's going to be a rather somber 2018 and a rather stock-specific one at that, where you have to really be selective, it can't really be that basket approach that worked well for you in 2017. Where else are you finding value, and where is it that you're recommending profit taking right now in this current wave of correction/volatility?
So there is a two-way approach. We are also recommending stocks to buy, and we are also cautious on few sectors. If I remember the conversation we had before the 3Q season began, I had pointed out that metals, NBFC and cement are the sectors where I am finding valuations a little rich. And we are seeing what is happening on metal stocks also, especially given that a lot of those guys are looking very ambitious to buy the assets which are up for NCLT resolution. So therefore the balance sheet stress can go up there, and incrementally the valuations will look expensive for them as well. NBFC, clearly where the yields have gone up, you will have to be very selective in that space. Stocks have done exceedingly well over the last 2-3 years. Valuations are looking expensive even there, and incrementally given the cost of funding environment, I think it pays to be very cautious and selective in that space. Cement, again, I think valuations are very rich on that front, and therefore one has to take a very stock specific approach. Plus within the cement space you have had some acquisitions over there, so numbers are not very uniform in that sector, but clearly valuations are very rich. And lastly, on consumption, I think while the earnings growth will improve, the story is progressing pretty well. In fact, one of the positives of 3Q FY18 earnings season was that it reaffirms our faith in the consumption story for FY19 as well. This is a story that we've been very bullish on for the last 8-9 months, more so on the rural side. And in fact, the 3Q FY18 earnings season, if you delve into the details, even urban consumption seems to have picked up, the likes of jewelry, the likes of QSR, the durable space. So I think consumption story will do well. Earnings will be very strong there. But there, what is to be, one needs to pay hit to the valuations, because if P compression happens, given what the cost of capital environment has been and the way bond yields have gone up, very little, if any, room is there for valuation re-rating even in that space. So while earnings can come in that space, you may see incremental PE compression happening, and therefore you will see prolonged time correction also. We have seen that happening in some of the consumption stocks in the last 2-3 years. Asian Paint is virtually flat for the last 2 years. Marico, we have seen very strong PE compression over the last 2 years. So this can happen in other consumption stock as well, even though the earnings picture starts improving over there.
Yeah, it has been. And since you talk about consumption, Gautam, top of my mind is some of the PE compression that you've seen in the likes of Eicher Motors, or for that matter, even Maruti. The fact that it had that touch and go moment with 10K last year, and ever since then, the stock has retraced. Are these good entry points back again into these stocks? Would you recommend buying into Eicher and Maruti right now?
I would. See, the difference between auto and FMCG has been the consistency of volume growth. The monthly numbers have been very strong for the auto companies of late, whether it is two-wheeler space or four-wheeler space. So I would love to buy Maruti at this valuations after having corrected 12-13%, because remember at 10,000 we were saying we're looking for an entry point. If the stock comes off 10%, 15% from where we are, it will be a very attractive entry point, and that has happened now. So I would not be too worried about what happens in the next 3 months or 6 months in terms of commodity inflation and therefore the impact on their margins. But I would reckon that these are very good entry points for both Maruti as well as Eicher. And of course, we remain very positive on the rural play. So M&M continues to find a place in our top large cap ideas still.
Gautam, we all know that this is a state election year, and then, of course, this is the semi-final to the grand finale, that's the 2019 elections. And typically one sees as to how stringent the state governments also get in an election year on some of the liquor companies. We've already seen an excise duty hike by the government of Karnataka, Maharashtra as well, toggling with the same. Why a buy call then on United Spirits? I know the volume and consumption story remains intact and nothing can really stop that. But why is it that you believe that this is a good stock to own even at the current levels?
See, the story on liquor, one has to look beyond 1 year or even 2 quarters, because the real game in liquor is the long-term premiumization which is underway, and this has been happening for last 3 years, and it's now getting into an accelerated phase. That is point number one. Point number two is that the mix improvement, which I was just talking about, this is not a tactical mix improvement. This is a very structural mix improvement, because do understand that the top two players, both MNCs, now command more than 60-65% of the market share, and the industry's focus itself has moved from volume to value. So that will continue to play out, and it will have a very strong repercussion on the P&L of a lot of these companies. So while one part of the market, which is your 50-60% of the market, is still government control, the large southern governments, and you are incrementally seeing go-to-market changes happening even in Punjab, Haryana and UP. But the fact remains that the underlying growth is very strong for the premium portfolio. That is, and second number is that the point number two is that the balance sheet continues to improve for United Spirits. You have improved the balance sheet, characteristics, whether it is leverage or whether it is capex intensity, that has improved in the last 2-3 years. And non-core asset sale, if what they have guided for over the next 1-2 years, even if it happens in 3 years or 4 years, that will provide more legs to the ROE improvement as well as the overall capex intensity improvement in that balance sheet. So structurally, the opportunity is uncontested. We still have a very long way to go in terms of penetration as well as per capita. And as I said, mix improvement plus balance sheet improvement, both are happening concurrently. So the drivers are changing. The structural dynamics of the industry has undergone a sea change. While the government will continue to, provide speed breakers, but such is the nature of the industry. It also creates an entry barrier for the new competition. So valuations are going to remain expensive there. One has to see whether one is in it for 1 year or one is in it for 3 year, 5 year. I think from a 1 year perspective, it will still have a lot of volatility, because you still have 2-3 states where go-to-market changes will happen, and you will not see stability returning on volumes or even on margins till at least April-June quarter. So it's not for somebody who has a short-term view, but it's clearly a very long-term story which is playing out.
Gautam, hi there, Avan joining in, and wanted to get in your view on the metal space. And like a lot of market experts, you too seem to be echoing the same sentiment that one should remain a tad cautious on the space as a whole. How are you looking at the overall global cyclicality factor, and how do you expect that to impact the metal space as a whole? Do you think that this would be a blanket call, or are there some specific metals names that you would perhaps veer toward?
Demand improvement plus the policy support after the government measures into 2016. Now, what is also playing out is the base effect. You've had 4 quarters of triple-digit earnings growth in metal universe for us. I think that will start, impacting the numbers going forward. Secondly, some of the actions which are happening on the NCLT cases, while the businesses are taking those calls based on their 5-year, 10-year horizon, but one needs to remember the cross-cycle valuation for a lot of these companies, plus cross-cycle EBITDA per ton that they have generated over a period of time. We are at the peak EBITDA per ton cycle of this sector right now, and at that point of the cycle, if we are looking at incremental, 40-50,000 crores being committed to a lot of these steel companies, then clearly the near-term performance from a 2-year, 3-year picture can get impacted. And at the same time, one has to always keep a view on valuations, where I think after 4x, 5x rally in the last 2 years, it pays to be cautious. You might exit early, maybe 10, 15, 20% you will miss. But I think this is a view one has to take on stocks or sectors which have had a very strong rally, and where incrementally you are hitting the peak range of the long period average valuations.
All right, Gautam, let you go on that note. Lovely chatting with you, getting a perspective on your top sector bets as well as your general outlook on the market volatility and the implications of the all-important elections as well.